Hey, how y'all doing today? Welcome back to D's Daily DD, the channel where we talk about our favorite stocks and we learn and we grow together, right? So today we have a special video, kind of like by request, I would say, because when I go through the information, I know that I kind of move fast and some people get lost a little bit, right? We do have some new traders, some people who are just starting to learn. So I'm gonna make this video so I can talk about some trend lines and some patterns, technical patterns. So we're going to go over a lot of definitions and technical analysis information, right? So if you're into that kind of stuff, if you're already a pro, then this is probably not for you, but we're going to cover some vocabulary and we're going to look at a couple of charts and a couple of definitions. That way we can get a better understanding of what technical analysis is. And the way I learned it is just kind of like self-taught and experience and just looking up information and just looking at charts over and over, right? So before we waste any more time, let's get straight to it and switch over. Alrighty then. Hope you're having a good day. If you at any point need to pause the video or take a notepad out or pause the screen, another thing I will do is I will put the Investopedia link. That's where we will be pulling most of our information from, and then a couple of charts on Webull as well. Okay, so check this out. So when you're getting into trading and you're looking at charts, basically, all you're gonna look at is something like this. Where you just get a plain chart, you have your line or indicators, or you have your volume. You have all these tools available to you if you know and learn how to use them. They do come in handy when it comes to analyzing the charts, right? So let's take a look at this chart real quick. This is my chart on Webull, and this is some of the work that I've done, right? And I'll kind of explain what is going on here and why I drew this stuff, right? But like I said, when you first just open a chart, it's going to look something like this. Okay. Let's go over to this Investopedia part right here. So this is an introduction to technical analysis and price patterns. I'm going to go over some information. It should be about a 10-minute video, so nothing crazy. So let's read into this, right? So in technical analysis, transitions between rising and falling trends are often signaled by price patterns. By definition, a price pattern is a recognizable configuration of price movement that can be identified using a series of trend lines or curves, right? So there could be a straight line, it could be a curve. There's different things called like a cup and handle or a wedge or a bull flag, and that's all listed here, okay? So when a price pattern signals a change in trend direction, it is known as a reversal pattern. A continuation pattern occurs when the trend continues in its existing direction following a brief pause. Okay, and in technical analysis have long used price patterns to examine current movements and forecast future market movements. Okay, so it doesn't necessarily tell you the future, but it is a tool to kind of gauge where the trend is and what the price is and where the price is headed, right? So I have used a lot of this stuff over and over and over on different charts. And once I get a new chart, once I get into a new stock or whatever, and we just get a blank chart, I will start charting. And that's why it's good to learn this stuff so you can move along with me and see what I'm talking about, right? Some key takeaways. Patterns are distinctive formations created by the movements of security prices on a chart and are the foundation of technical analysis. A pattern is identified by a line that connects common price points, such as closing prices, highs, and lows during a specific period of time, right? Okay, so as we move down, you can go ahead and click on this link, right? Investopedia. I'll put it in the description down below. But what I want to do is kind of move a little bit further down. Let's look at this real quick. And remember, you can do these technical analysis on any chart. It could be a 2-minute chart, a 5-minute chart, 10-minute, the 1 day. Just depends if you're zoomed in or out, right? So uptrends occur where prices are making higher highs and higher lows, okay? So what that means right here, this is like pretend there is a line right here that goes through here right now. So you see these higher highs right here, higher highs, and then you got your higher lows over and over, okay? So this is definitely, this is Bitfarm right here. We've talked about Bitfarm on the channel. If you see, it's on this huge uptrend right now. and it's higher highs and higher lows. And the same thing for when it's on a downtrend, you're gonna get lower lows and lower highs. Okay, so same thing whether it's an uptrend or downtrend. Okay, and then another thing to know is called consolidation. So consolidation is when the price is just going sideways, right? You see sometimes that the price is just going like this because that's just called consolidation. It just means that a price is oscillating between an upper and a lower range between two parallel and often horizontal trend lines. So it's kind of like the middle of the trend, right? So let's talk about some continuation patterns, right? A continuation pattern can be thought of as a pause during a prevailing trend, a time during which the bulls catch their breath during an uptrend, or when the bears relax for a moment during a downtrend. In general, the longer the price pattern takes to develop, the larger the price movement will be within the pattern. The more significant the move once price breaks or above or below the area of continuation. So you have these three basic ones right here. You got your pennants, your flags, and your wedges, okay? So this is going to be a pennant. Right here, boom, okay? Pennants are drawn with two trend lines that eventually converge. A key characteristic of pennants is that the trend lines move in two directions. That is, one will be a downtrend line and the other will be a uptrend line, okay? So that's a pennant, and then often volume will decrease during the formation of the pennant, followed by an increase when it eventually the price will break out of the pennant, okay? So this is called a breakout. You have your pennant and then a breakout, okay? A flag. Okay, so the flag is one of my favorite ones because most people think it's going to be a sell-off. They think it's going to be a downtrend, right? But it's actually a trick. It's actually a psych out, right? They'll fake you out. The flags are constructed using two parallel trend lines that can slope up, down, or sideways, horizontal. In general, a flag that has an upward slope appears as a pause in a downtrending market. A flag with a downward bias shows a break during an uptrend market. Typically, the formation of the flag is accompanied by a period of declining volume, which recovers as price breaks out of the flag formation. Okay, so this is the flag right here: up, down, up. Okay, so you can see right there that it's gonna go up, trick people, come back down, and go up again. Okay, so that could cause you to sell off right here. Like you bought here, you're going up, you're like, oh no, it's going down, you sell off, but in reality, it's going higher. Okay, so that's the bull flag. The wedges, okay, wedges are similar to pennants in the way they are drawn using two converging lines, right? So they're gonna meet. What it's talking about is right here. It's gonna meet. And a wedge is characterized by the fact that both trend lines are moving in the same direction, either up or down. A wedge that is angled down represents a pause during an uptrend. A wedge that is angled up shows a temporary interruption during a falling market. As with pennants and flags, volume typically tapers off during the formation of the pennant, only to increase once the price breaks above or below the wedge pattern. And that's wedges and triangles are very similar, as you can tell here, right? So triangles are among the most popular chart patterns used in technical analysis since they occur frequently compared to other patterns. The three most common types of triangles are symmetrical, ascending, and descending triangles. These chart patterns can last anywhere from a couple weeks to several months. Wow, that's something I didn't know, right? So we all learn. And then, so if we take a look at this is basically your triangle. Right? So the reason I drew this triangle here is because it was in a downtrend. And then I started to notice that it bumped up above the supply zone and demand zone. This is one of them. So that's how I knew this bit farm was about to make a move up, especially once I got confirmation right here, right? This to me, when it bounced right here, that was a lot of confirmation. That was the way, that's what told me that this was getting ready to make a move up. And we got the support, bounced up to this zone, right? I draw this trend line, and I like to follow what's called the ABCDE patterns. So if you take a look here, is this will basically be like your A, B, C, D, E. You got A, B, C, right? So the all-time high for this is going to be $10. So I would expect it to continue to $10 to see if it's going to be able to pass that. And once we get to that zone, I will have to redraw new things on the chart and see where we're at then, right? But the chart is telling you the history. It's going to tell you what happened in the past, right? So it's all about what happened and taking that information and moving forward with it, okay? So we scroll down, you got your cup and handles, which is here's your cup, here's your handle. And it's a bullish continuation pattern where an uptrend has paused but will continue when the pattern is confirmed. The cup portion of the pattern should be a U and resembles the rounding of a bowl rather than a V shape, and the equal highs on both sides of the cup. So it's just talking about right here. That's a cup and a handle. That's a bullish thing, so that means that most likely the price will continue up. Okay, these are reversal patterns. Okay, so once you see a trend go up or down, then it's called a reversal, right? It's going to hit a peak, like I said, with the bit farm right there. If it does reverse, it's going to be around $10, I think, as we look at this over here. So right now, this was a reversal, right? So reversal, reversal. Now we're going on an uptrend, and then we got to see where the next reversal is. And these are your typical patterns for it. So a head and shoulders, double tops, and double bottoms. Head and shoulders. These patterns can appear at market tops or bottoms as a series of 3 pushes. An initial peak or through, followed by a second and larger one, then a third push that mimics the first. There you go. Your shoulder, your head, and your shoulder. Boom, it breaks out. And like I said, I will put the link. I just don't want this video to go on forever. So I will put the link down below if you need to study this a little closer. You got your double tops. The bottom signals where the market has made 2 unsuccessful attempts to break through a support and a resistance level. In the case of a double top, which often looks like the letter M, an initial push to the resistance level is followed by a second failed attempt, resulting in a trend reversal. Okay, so this is also known as a W. So I've seen it referred to as a George W, right? That's the way I look at it. But it's also known as a double top. And then gaps. This is the last one, right? So gaps occur when there is an empty space between 2 trading periods that caused by a significant increase or decrease in price. So it'll be a big jump up or a big jump down. For example, if a stock might close at 5 and it opens at 7 after positive earnings or other news, right? So the gap up can happen up or down. And there are 3 main types of gaps. There's breakaway gaps, runaway gaps, and exhaustion gaps. Breakaway gaps often form at the start of the trend. Runaway gaps form during the middle of a trend, and an exhaustion gap is near the end of the trend, okay? So the bottom line is that price patterns are often found when price takes a break, signifying areas of consolidation that can result in a continuation reversal of the prevailing trend. Trend lines are often important in identifying these price patterns that occur in formations such as flags, pennants, or double tops. Volume plays a role in these patterns, often declining during the pattern's formation and increasing as price breaks out of the pattern. Technical analysts look for price patterns to forecast future behavior, including trend continuations and reversals, right? Again, we went over gaps. We went over double tops, double bottoms, triple tops, head and shoulders, reversal patterns. That's what those are. This is a bullish pattern, the cup and handles. The triangles and the wedges, okay? One of my favorites, the bull flag and the pennant. This is one of my favorite website, guys. So if you need it, Investopedia. Alrighty, hopefully that taught you a little bit about technical analysis. Those are the most common patterns. There is a lot more that you can research and look into, but if you're interested, that's technical analysis patterns, right? So I'll go ahead and put the link below. If you learned and liked this video, leave a comment, hit that like. That really helps out with my the YouTube algorithm thing and all that. So hope to catch you soon, and I will be putting out another video out today on the market recap and the summaries. Okay. So this was again just a learning video. And again, I'll see you next time. Okay. Have a good one.